Hello everyone. So, imagine two companies working together. They are too big for simple investment, but they don't quite control each other. How do we account for financial partnership? So, the answer lies in IAS 28, Investments in Associates and Joint Ventures. And the powerful tool it mandates is the equity method of accounting. So, over the next 6 minutes, we'll clarify what an associate and joint venture are and, most critically, understand the mechanisms of the equity method. So, the first slide that we are going to talk about is what is a joint venture and an associate. Associate is a company over which the investor has significant influence but not the full control. This is also like a subsidiary. Here you can have influence but not control over the decisions. Let's take an example. Suppose company A buys 30% of stake and company B gets access to it. Now company A also gets seat in it on company B. So therefore we can tell that company B is an associate of company A. So what is a joint venture? Joint venture is a formal agreement where two or more parties share joint control. This is a key difference between decisions on relevant activities which require the anonymous consent of parties sharing control. So, for these both associates and joint venture, the required accounting method is the equity method. For joint venture, let's take an example. So the company A and company B buys and creates a separate entity called Super Batteries and Co. They own 50% each of contract required, both to agree on all decisions. So here we can say that two parties has to agree on all decisions and to have a joint control over their product or the entity that they are going to prepare. Key definitions of significant influence and joint control. Significant influence. We can significantly influence a company's strategic operations, investments, and financial decisions that are being made but cannot dictate them. This can help in participation in policy decisions, supply or technology arrangements, broad representation, and managerial influence. Next is joint control. Joint control means that no one person can make important decisions alone. They just have to agree everything on big and share the power equally. It guarantees that all partners have an equal voice and equal power over the venture. They have shared decision making authority, equal veto rights, structured governance. This slide explains how companies account for business deals that they do together, which are called the joint arrangements. There are two types, joint venture and joint operations. In joint venture, let us take a small example and see how it works. So, think of a joint operation like two people building lemonade stand side by side. Here, each partner has a direct claim on the specific things, like one keeps table and another keeps the cup. So they are also directly responsible for the specific debts like liabilities, like paying their own half of the lemons. So we can tell that parties have the right for individual assets and obligations for individual liabilities. This is all comes under joint operations. Next is joint venture. Here also we'll take an example. Think of a joint venture like people investing money in a separate company that runs lemonade stand. They don't touch the stand itself. So here the stand assets and debits belong to separate company that was created. And the partners only have a right to share of the net assets, which is just a company's value. And all is that debts are paid. In simple terms, so they only get a share of the profit or the loss. So here we can say that parties have right to net assets only. A separate legal entity holds the assets. So this slide explains equity method of accounting. This equity method mostly reflects on the economic method. Let's see the steps. The first step is initial recognition, starting point. In this, you record the investment at an actual price that you have paid. The details is that the investment is recorded at cost, including any transaction fees that you have paid to get it. So the journal entry goes like investment in associate data to cash. Next step is subsequent adjustment, adjusting for the performance. So in this, you increase or decrease your investment value to reflect your share of the other's company profit and loss. So the carrying amount or the investment that is adjusted up or down is based on your share of the investee profit or loss for each period. Next step is dividend recognition, means getting paid. Here, when the other company pays you a dividend, means a payment from their profit is being treated and is getting some of your original money back, not as a new income. Here, mostly distribution received or the reduced the carrying amount of your investment, they are treated as a return of investment rather than the income or the profit item. Here the journal entry goes like cash debtor to investment in associate. Next is other comprehensive income OCI inclusion. Here in this, if any other company reports any specific changes or some special type of changes, then you also record your share of that change in specific account called the OCI account. Here you recognize your share of other comprehensive income to maintain the consistency with the investee's financial report. So, the main goal of this method is that it ensures that your financial statement provides a clear and consistent picture of the true value and the performance of your investment. The rule IAS 28 is the accounting standard that says the equity method must be used for both associates and the joint venture where you share and control the decisions. So this slide explains situation where company doesn't use the equity method. As we talked, equity method is usually used when one company has the significant influence over the other. But in some companies, especially those whose entire business is just investing and they don't use the equity method. Instead, they try and they treat their investment like regular stocks and bonds valued at their current market price. There are three main reasons why a company doesn't use equity method. First, investment in entities exception. If a company's main business is just investing to make money on buying and selling assets, it doesn't use the equity method. Next is entity exemptions. In this, the specific types of investment organizations like venture capital firms and mutual funds are always exempt because their focus is mostly on the money management. So, for an example, a mutual fund owns 25% of a stock. It simply reports the market value of those shares. Next is long-term interest. In this, other long-term financial report relationships like associated companies are handled. This highlights recent changes of two accounting rules, IAS 28, investment in associates and joint venture, and the IFRS 11, joint arrangements. So the recent accounting changes are the 2014 amendments which clarified how to handle the sale or contribution of the asset between company and its associate or joint venture. It helped fix when to recognize the profit or losses and how to measure them. Next is the 2017 clarification, which defined when and how to apply the IFRS 9 rule to long-term interest in associate and joint ventures. Next one is ongoing improvements, which mostly focuses on the making the equity method of accounting more consistent and requires more detailed disclosure in the financial reports. So this slide is overview of the joint venture accounting in practice, which specifically focuses on how the company reports its interest in a joint venture within its own consolidate financial statement. So this method describes how a company accounts for its share in a joint venture. Instead of blending all the joint ventures individual assets, liabilities, revenue and expenses with its own, the joint venture uses a specific simplified approach. So the first one is consolidate presentation, which is income statement. Here one line simple reporting, clear share, consistent income are the main specific themes. And next is asset recognition, which is also balance sheet. Here the venture does not include the joint venture's individual assets or the liabilities on its own balance sheet. So the here we can tell that a joint venture is like a two captain on a ship where they both must agree on the course. But in associate, it's like being a powerful advisor on a ship where the main captain listens to you but ultimately makes the final decision. So lastly, this slide outlines some four key concepts about accounting standards for investment in other companies. First one is the framework foundation. This is also called as the rule book. It means that the accounting rules, especially the IAS 28 and IFRS 11, are the official rule book for how companies must record their investment in two specific kinds of partner. Next one is the classification drive treatment. It means how you label your investment. It may be an associate, it may be a joint venture or a joint operation. It is the most important decision. Next one is third one, stay current, means keep up with the changes. The accounting rule makers like the IASB frequently will make updates and amendments to these rules. So following up these rules or staying informed about these changes make sure that they are compliant, and it prevents big mistakes that could force them to restate their past financial reports. And the last is the investor transparency. It means that following these rules ensures that a company's financial reports on its investments are clear and consistent. So lastly, conclusion. So as we saw till now, what is a joint venture, types of joint arrangements, what is an associate, how equity method is used, why does companies don't use the equity method, also the key concept. So by this, we can say that they provide some clear and consistent framework for accounting for investors in associates and joint venture. So this is all about IAS 28 and IFRS 11. Thank you.